Don't confirm ready. So good evening, class. Um, yeah. So we're going to start this class by in the next, let's say 5 minutes max, we would commence. Okay, so we shall commence now. So you're welcome to week 2 of our corporate reporting class. Today, we are going to move forward with our class on corporate reporting. Last week, Tuesday, we started with an overview of corporate reporting. That was what we started with first. And we also looked at regulatory framework. So today, we'll move forward into conceptual framework. And remember, I told you that regulatory framework constitutes 5% of your syllabus. What we're doing today also is 5% of your syllabus as well. And we mentioned last week that regulatory framework basically are the regulatory framework are the rules and principles that governs reporting. Yeah, sorry, I got a message from Dan. Yeah, so it's a topic at level, so which is why we are looking at this. So if you can read Daniel, so and when I get to class Sunday, we are still going to look at it. Yeah. Okay, so we mentioned that the regulatory framework basically are the rules and principles that governs reporting. And beyond the rules and principles, there's also the regulatory bodies that develop those rules and principles. The rules and principles, we narrowed it down to GAAP. That's majorly the National Accounting Standard, the National Company Law, and the Local Stock Exchange listing requirements, which we explained in detail. And you see, each of these GAAP could either be rule-based or principle-based. Ideally, IFRS is principle-based. So some other parts of the GAAP, like company law and local stock exchange listing requirements, are rule-based. Then we went on to the regulatory bodies, and we said that the regulatory body that's responsible for financial reporting in Nigeria is the Financial Reporting Council of Nigeria, headed by Rabiu Olowo. And as it is today, every professional that's practicing auditing and accounting is expected to register with FRCN. Not only that, if you are anyone that has an input into the financial report, you're expected to register with the FRCN. Also, all companies are expected to submit their financial statement with FRCN, and FRCN usually do come for a few days to check your level of compliance. And their key and the most important objective is to protect the interests of investors and other stakeholders. And their other objectives usually follow up from there, like to provide guidance on issues relating to corporate governance and financial reporting, to ensure best corporate governance practices are adopted by entities, and the objective we have discussed. And we ended it saying that it is not the FRCN that actually developed IFRS. There is a complete structure behind IFRS, starting from the monitoring board, who majorly comprises of capital market authorities, and they are there to ensure public accountability of this structure. And a major body that constitutes the monitoring board is the IOSCO, and the SEC of most of these developed countries are a member of the monitoring board. So the monitoring board is at the top of the cadre of this structure that backs up IFRS. Then the monitoring board appoints, you can even fire the trustees of IFRS Foundation. And the trustees of the IFRS Foundation are those that have the objective to develop a single high-quality accounting standard in public interest. That is their first objective. The second objective is to promote the use and rigorous application of this standard. The third objective is to take care of the needs of SMEs and emerging economies. And their fourth objective is to ensure harmonization and convergence of international accounting standard. So all of these has really helped them tremendously, that as of today, over 144 countries adopt IFRS. They are achieving the objective. Beyond that, the IFRS Foundation has delegated most of this responsibility to the ISB, who now owns the responsibility of developing IFRS. And there is now the ISSB. The ISSB is the International Sustainability Standard Board. This board are responsible for developing IFRS sustainability disclosure standards. And also there is the IFRS Advisory Council that advises and also provide a link between the public and these standard setting bodies, that is the IASB and the ISSB. And don't forget the IFRS Interpretation Committee that provides interpretation where there is a conflict in opinion in interpreting IFRS, or where there is no IFRS for a transaction or events. Then these guys will come up with an interpretation to resolve the issue once and for all. And that's the structure behind IFRS. And we also looked at how we set IFRS, starting from the step one, which is agenda consultation, that majorly entails comprehensive review and also fair consultation, and also development of a work plan. And after this consultation has been done in the step one, then they go on to the research program, where they actually identify that, yes, there is really an accounting problem. And at that stage, they would provide a solution. And when they have provided a solution, they would put that in a discussion paper that will be sent out to the public for opinions and comments. When they receive that, then they will update it, and finally they will come up with a proposed IFRS. This is not an IFRS yet, it's a proposed IFRS, which they are going to codify in an exposure draft. And this exposure draft will be sent out to the public also for comments and opinion. And when they have refined this exposure draft over and over again, through the comments and opinions they are getting from the public, eventually becomes an IFRS. And usually that is the end of the step 3, which is the standard setting program. It doesn't end there. When the IFRS is published, they continue to maintain this IFRS. And this maintenance majorly requires post-implementation review. And this post-implementation review, the guy that does the major work is the IFRS Interpretation Committee, making sure that people or professionals are not having difficulty in interpreting, understanding, and applying this IFRS. If such difficulty exists, they intervene. They come up with an interpretation and make people understand that, okay, this is how we do about it. And I can remember giving you some assignments, which I'm sure you must have looked at, like argument for and against the advantages and disadvantages of rule and principle-based work, as well as rationale behind regulation. Why do we need regulations? Okay, these are past questions. And the note I sent to you, it is there already. So I hope you're able to read those parts. Okay, that was what we discussed last week. Yeah, it is theoretical. I mean, let me prepare your mind again today. Corporate reporting is, don't expect that is calculation. No. Ideally, it's like 60% principles, me talking, explaining stuff to you, understanding key things, and it's like 40% calculation. Even in your exam, the ratio is going to be like 70-30 or more. So it's more of principles. You need to carefully understand this thing and devote your time to understanding the core principles that backs up whatever it is we want to calculate eventually. Okay, so today, what do we have in front of us today? What we have in front of us is the conceptual framework, and that is what we want to do today. So firstly, let's understand what is this conceptual framework. what I have here, majorly, I said that conceptual framework is a statement of gap, right? It's a statement of gap. So is different. So what we are saying here is that statement of generally accepted theoretical principle, which is almost similar to the rules and principles that we talked about. But this guy, yes, is still gap, we have to call it, but it goes beyond that. Conceptual framework even goes beyond that. Because conceptual framework form frame of reference for financial reporting. When I say frame of reference, about a tool or something that we eventually refer to, that we ultimately have to make reference to. It looks similar. It looks as if we are talking about the IFRS. No, you see, the conceptual framework itself is what provides the basis for the development of the IFRS. So the conceptual framework is what is used to develop IFRS. And anytime they need to amend an existing IFRS, what they use is the conceptual framework. And that's what this first sentence is talking about. So we can easily say that the conceptual framework is the foundation of reporting. Because if you remember, when we're learning regulatory framework, we said that the regulatory framework majorly are rules and principles. And one of those rules and principles is IFRS, right? Now, today we are looking at what is used in developing that IFRS, right? So we can conveniently say that what we want to learn today is the foundation or the source of financial reporting. That's what we are learning today. And that is the first thing I need you to know about the conceptual framework, that it is the tool that is used to develop the accounting standard. In this context, the IFRS or the IAS, as the case may be. Therefore, we can simply say it is the foundation of financial reporting. Now, being or having something that is used to develop the IFRS, right? You see, ultimately, what will happen to the IFRS is that it's going to have similar structure, ultimately, and to have a kind of sense of direction. They won't just be developing IFRS anyhow, since they know that, okay, when we want to develop an IFRS, we have a basis. We have a basis. So to understand what I'm talking about, I gave an analogy here of a blueprint or a building plan of a house, right? So if you want to build a house and you have your building plan approved by the state where you want to build a house, then you use it to build your house. You know, if another person uses the same building plan, what will happen is that everybody that uses that building plan, their houses will look similar. They will have similar structure. However, it is when you enter the house that you will see similarities in terms of design, the kind of chairs they want to use. So it's the interior that will change, but the structure of the house, where each room is located, the core physical structure is going to be similar. And that analogy is the same as the conceptual framework. You would see that every IFRS has similar structure. All of them, when you are looking at IFRS on assets, for example, now, their recognition criteria, their measurement basis, and also their presentation, the ideology is the same. It's the same. And every standard is all about introduction, definition of terms, recognition, measurement, presentation, and disclosure. The same structure. Just that they are dealing with different items. Some are dealing with assets, some are dealing with liabilities, but the structure is entirely the same. I hope you understand the whole idea around conceptual framework. Having a single tool that is used to develop any IFRS. anytime one need to amend an IFRS, it is also this conceptual framework that they use. So with the level of importance of this conceptual framework, I don't think it will be difficult for anybody to think of advantages of this kind of tool. And one of the advantages, like I've mentioned earlier, is that it's going to give a sense of direction to whomever is developing the IFRS. In this case, mostly the guy doing the dirty works, the IASB, is going to make development of accounting standard, it will standardize it, and it's going to make it coherent. It's going to be standardized because they know what exactly they need to do. And it's going to be coherent. It's not going to be on a patchwork basis here and there. You won't just be developing it. No, there's standardized and coherent. There are steps to it, right? That's the first advantage that is extremely obvious. Another one is that the development of accounting standard will not be subject to political interference. Why is this an advantage? Because this might not be applicable so much in Nigeria. It might not be applicable so much in Nigeria. But in some other climes, for example, now, that really measure closely economic indices. You see, a politician, for example, who is the president, might want to push for treating certain items in certain way. If they know that, because cumulatively, when you want to determine the economic growth of a country, what you look at are the entities in that country. So by the time certain items are measured or presented in certain way, it might boost economic growth and the general perception and GDP of that country. So they might want to interfere in the process of developing accounting standard. But when there is a conceptual framework, nobody can interfere because we have a way with which we develop standards. So even if anybody attempts to interfere, it's not possible. This is how we cannot go against our framework, our conceptual framework. So again, the development of accounting standard will not be subject to political interference. It can never happen. And also is that with conceptual framework, the public, that is the users, will understand that financial reporting is based on a common ideology. It's based because we have a foundation, a singular foundation that is used in developing accounting standards. They know that it's based on a common ideology. So they know that our field is structured, simplified, and can be traced to a background, which is the conceptual framework. So user will understand that the accounting standard or reporting generally or accounting practice is based on a common ideology. And finally, is that whenever we have unusual transactions, that is transactions that we don't have standards for, then the conceptual framework can help with that. It can help in treating unusual transactions. Okay. You can think of more advantages, like you can foster comparability, you can improve credibility, a lot of other ones, but I'm giving you this. Then the disadvantages of the conceptual framework, for me, if I can criticize these disadvantages, right? I can criticize it because a tool as good as the conceptual framework, it's difficult for anybody to come up with a disadvantage that somebody cannot negate. That no, this one cannot be a disadvantage. But we have to have disadvantages. And the very first of these is that a singular conceptual framework cannot serve the need of varieties of users. You know, IFRS is adopted globally, and each individual country have specificity. They have certain issues that are specific to their countries, and that will prevail. So having a single tool to develop standard for everybody might not be so realistic. So we are going to take that against it. And that's why we are seeing that as a disadvantage, that a singular conceptual framework might not meet the need of varieties of users, okay? And another one is this. We believe that the conceptual framework should make the work of developing standard easier. That's the assumption. But the reality is this. Last week, we looked at the steps in developing accounting standard. That steps will never change. We will still go through consultation. We will still develop our discussion papers. We're still going to develop our exposure draft, and all of this takes time. So we can take this against the conceptual framework that it might not make the work of developing standards any easier. We can see that as a disadvantage also. Okay, so giving you two disadvantages, you can think of more, and this is highly examinable. I can have asked it. Yeah, they asked it around, I think, 2016. It's a long time ago that it was asked. They could ask it again for maybe 4 or 5 marks or 7 if it's advantages and disadvantages. And you don't want to joke with things like this because these are what makes you pass corporate reporting, all this theoretical part of the syllabus. Okay, then what is the purpose of the conceptual framework? This is different from the advantage, right? So when you're talking about the purpose, then we would be focusing on the guys, on the people that actually would benefit directly from this conceptual framework. So then we'll be looking at, okay, how would they benefit from it? Then it becomes a purpose for those people. And ultimately, it becomes a purpose for the conceptual framework itself. And the first guy I'm looking at here is the IASB. So the conceptual framework will assist the IASB to develop accounting standard, and it will also help them review accounting standard. I mean, that is what they do. They develop and review accounting standards. And since the conceptual framework is what they use in doing that, apparently it will help them in developing their standards. Not only that, it will also help in harmonization and convergence of international accounting standard. And remember, that's the fourth objective of the IASB, to converge and harmonize international accounting standard. It can help them to how? If all the countries in the world start using conceptual framework to develop their IFRS, certainly, or their standards generally, certainly they will all have similar standards. So if they can encourage countries to use a conceptual framework, so it makes their work easy. Harmonization becomes easy. Convergence becomes easy. Beyond that is national standard setters. So if they decide to use conceptual framework, it can also help them to develop their standards too, right? Also is the preparers of financial statements. When we are talking about the preparers, we are talking about the management of a company. They are responsible for preparing the financial statement of companies. So it makes it easy for them to prepare their financial statements through easy application of IFRS. So conceptual framework can make it easy to apply IFRS, okay? Beyond that is that it will also help the preparers to develop consistent accounting policies. Consistent accounting policy. For now, some of you might know what an accounting policy is. Some of you might not. For those that don't, an accounting policy is how an entity adopts the IFRS. Is how an entity has decided to tailor the IFRS to its own organization. Every entity must have an accounting policy. When you check every financials, there's always an accounting policy. Let me give you an example. IAS 16, for example, now requires that at the end of the year, you either measure your PPE, either using cost model or evaluation model. An entity now, where they will state the model they have used is the accounting policy. That becomes the accounting policy. They will state in the accounting policy that we have adopted the evaluation model, or we have decided to adopt the cost model. So, and in a lot of other standards and so, accounting policy is how you have, is like IFRS applied to your company. How you actually chosen to apply IFRS to items in your financial statements, right? So hopefully we will get to IAS 8. Like I've told you before, we're going to be using Dangote Group financial statement as our case study. I will show you the accounting policy so that practically you see it, and the exams become easy for you. Beyond this one, then the users like investors, like employees, like tax authority. So it can help those guys interpret the financial statement. It can help in interpretation. It can also help the auditors in forming an opinion on whether the financial statements comply with IFRS. It can help the auditors too. And also, whoever is interested in understanding how IASB develops their standard, it can help them understand it. It can help whoever is interested in the work of the IASB to understand how the accounting standard is developed. And finally, it can also help the IFRS Interpretation Committee in developing interpretations on IFRS. Okay, you see that if they ask you purpose in the exam, just remember these guys: IASB, National Standard Setting Bodies, preparers, users, auditors, IFRS Interpretation Committee. Then be able to know the use case for those guys. Then you'll be able to come up with the purpose of the conceptual framework. Okay, so finally is that I need to let you know that whenever there is a conflict between a requirement in an accounting standard and a conceptual framework, if there is a conflict, what I mean by conflict is the conceptual framework is saying when you have assets, this is how we generally should measure assets, but the accounting standard is looking at it from a different view, right? Who will prevail? Whose guideline will override? Here, the conceptual framework, this was in the conceptual framework. The conceptual framework stated that the requirement of the accounting standard shall override that of the conceptual framework whenever there is a conflict. Okay, so I'm done with the first section of this class because I can't see you physically. We would have to go through these quizzes together. At this time, you can unmute and answer if you wish to answer. So let's go through it together just for me to be sure that you were following me. So the first quiz here says that, which of the following best describes a conceptual framework? Which of the following best describes a conceptual framework? A states that statement of gap. B, accounting concepts. C, accounting principles. D, basis of accounting.
Statement of gap.
That's correct. Statement of gap. Nice one. Okay, so the next question states that when there is a conflict between accounting standard and a conceptual framework, which one will override? A, conceptual framework. B, accounting standard.
A, conceptual framework.
B, accounting standard.
Yeah, it's B, is accounting standard. That was the last thing I mentioned. The accounting standard will override the conceptual framework wherever there is a conflict. Okay. So the third question states that conceptual framework can help in treatment of unusual transaction.
True.
Yeah, that's correct. True.
A.
Yeah, true. That's correct. So the final question, which of the following is not a purpose of the conceptual framework? Which of the following is not a purpose of the conceptual framework? A, to assist the IASB in the preparation and review of IFRS. B, to assist auditors in forming an opinion on whether the financial statement comply with IFRS. C, to assist in determining the treatment of items not covered by an existing IFRS. D, to be authoritative where specific IFRS conflicts with the conceptual framework. So which of the following is not a purpose?
I feel
D.
Sorry?
D.
D.
That's correct. That's correct. Only this one that is not a purpose. Okay, fantastic. So that means you followed. Okay. So let me move on to the second section. So you can all mute now and listen attentively. Okay. So the next thing is the content of the conceptual framework. Remember, I told you that the conceptual framework helps or is used majorly to develop accounting standards, or say it in another way as that it provides a basis for the development of IFRS. So what is that basis? What is that thing that we are talking how we are going to look at it is through the content of the conceptual framework. So before now, we had a 2010 conceptual framework for financial reporting, 2010, but now there was a revision. It took them 3 years. They came up with a revision in 2018. So the conceptual framework we are talking about now or today is the 2018 conceptual framework, and that's what the examiner will ask you. And these are the areas of revision. They revise the definition of elements. They change how we recognize and derecognize elements. They change measurement basis, and they added principle for disclosures and presentation. So these were the new things. So what are these chapters, right? You have chapter 1, which is the objective of general purpose financial statements or financial reporting. Chapter 2, which is the qualitative characteristics of useful financial information. Chapter 3, which talks about financial statements and the reporting entity. Chapter 4, which talks about the elements of financial statements. Chapter 5, which talks about recognition and derecognition. Chapter 6, measurement. Chapter 7, presentation and disclosure. And Chapter 8, concept of capital and capital maintenance. So I believe that any reporting students must, by heart, be able to know Chapter 1 to Chapter 8, be able to write it and know it by heart. It's because this is virtual. In class, I know this by heart. Yeah. Okay. So Chapter 1, which talks about the objective of general purpose financial reporting. I think this makes a lot of sense for Chapter 1 to be the objective. I mean, we are talking about financial reporting here, talking about reporting generally. So it makes sense for the Chapter 1 to be why financial reporting. What does financial reporting wants to achieve, right? So, and that is what we're going to quickly learn here. So this Chapter 1 majorly talks about the objective of financial reporting. So in there, we're going to be looking at the information that users need. We are going to be looking at the users themselves, and that's what we'll be looking at in this Chapter 1. So what is this objective? So the objective is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. Okay, we should all know this again. You should all know this. So the core thing here is this: to provide financial information. That's the core thing. So we need to know what is this financial information they are talking about. We will get there. Financial information about a reporting entity. I won't talk about this reporting entity. You all know what reporting entity is generally, but we are going to learn it in Chapter 3. Chapter 3 talks about financial statement and the reporting entity. So we'll get there. So they say that is useful to potential and existing investors, lenders, and other creditors in making decisions about providing resources to the entity. So where the controversy came in is this. So they said that we are now providing information solely to this set of guys, existing and potential investors first, lenders, and other creditors. They were so specific about these three people. I mean, it's just so straightforward that it means that the objective of reporting is to provide information to these three sets of people. Hold on, what about the others? What about the government? What about the tax authority? What about the international community? What about the employees? Don't they need financial information too? Of course they do. But for us, accountants, we are providing information to this set of people. So since that is what the conceptual framework has said, whenever we are presenting or preparing our financial information, these are the people we need to have at the back of our mind. And the reason is not far-fetched, right? The reason is because it is these three sets of people that actually provide resources or risk capital to the company. It is the investor that has said or that believed in the company and said, take this money, go and use it to run your business. Imagine a company struggling that you only needs 10 million naira just to move a step forward, and it can't find anybody to fund. One of the top reasons why businesses fail is because of lack of financial resources. If you don't have money, you don't have it. You have to close down. You can't pay salaries, you can't pay rent. You would close down, right? So an investor is the guy that says, okay, I believe in your vision. Take this money. Let's take this risk together. So who else should you provide information to, if not to that person? Or a lender that says, okay, I will give you this money, but I don't want to be a part owner, because an investor becomes a part owner. The lender says, I don't want to be a part owner, but at this date, I would collect my money back and you pay me interest, right? That's a lender. That guy is instrumental to your success. You need to provide information to him, specially. Also, his other creditors, the guys that gives us free goods. They give us goods that go and sell. When you make money, come and pay me. These are the primary users of financial statements. And your examiner have asked it before for 5 marks, that you should list the primary users of financial statements and their information need. 5 marks. That's so simple. But that was the first time they were going to ask it, around 2019. This thing just came out. And a lot of centers were even still teaching students 2010 conceptual framework, where everything was different. So a lot of students actually failed it, and ICANN has not asked it since that time. Hopefully they will ask it this diet, where you guys can get cheap 5 marks. So looking at, we already know the primary users now, existing and potential investors, lenders, and other creditors. But what do they need information for? That is not also easy to find. The investor, majorly they need this information so that in making decision, okay? But the decision the investor wants to make is different from the decision lender wants to make, different from the one other creditor wants to make. But ultimately, the goalpost is the same. All of them, they want to decide whether they should continue to give you money or resources, majorly, right? So investor is saying, okay, should I buy or sell my shares in your company? If the company is doing poorly, you will sell. If it's doing very well, you even want to invest more. Lenders, for example, now, the guy wants to also make a decision on whether he should give you additional loans or not, right? And of course, what will determine that is the information you have given to him. The information will have shown your liquidity. The information will have shown the assets you have. Do you have sufficient assets as security? The information will have shown the further exposure you have. Do you have further loans? You know, it will have shown a lot. But what he needs those information for is for him to decide whether he should lend you money or not, majorly for these guys. And lest I forget, this investor, beyond just making a decision about whether he should buy or sell your shares, he will also use the financial information to make decision on how he's going to vote during general meetings, right? Because they can easily vote and say the MD should resign or the whole management team should park away, they are very powerful because they are the owners of the business. Okay. Other creditors will also make decisions about whether they should continue to provide trade credit to you, right? So I have some points here, but the way I've explained to you now, of course, this video is recorded. When you listen to it again, it's even easier than what I have here. That would help you raise points, even when you can't remember all of these things you must have read. From looking at whom the investor is, you can know what he needs to make decision for. The same thing as lenders and other creditors. Moving forward, still on chapter 1 is the financial information. And what is this financial information? They have asked this before, that what, according to the conceptual framework, what financial information is provided to users? So this financial information represents management stewardship. You know what stewardship is? Stewardship is that, I don't know how to say it in English. Is I mean, that's what the Yoruba people will say. But stewardship is saying that, okay, this is what I've used your resources for. The money you gave to me, this is what I've used it for. So the only you will be showing majorly are the economic resources of the entity, which are assets of the entity. Of course, it's the money they give you that you will use to buy assets. Claims against the entity. In one of my classes, I told them it's claims against those resources, right? It's smooth when you're saying claims against those resources. But I know in the book itself, it's claims against the entity. But here, this is majorly liabilities. Liabilities majorly. And changes in the entity's economic resources and claims. So, meaning increase in resources or decrease in resources, or increase in claims or decrease in claims. So resources is assets. When your assets increase, what is that? Income. When it decreases, expense. When your liability increase, is expense. When it decreases, income. So what this point 3 is talking about is income and expenses. So the information you're actually providing to the users are assets, which is economic resources of the entity. 2 is liabilities, which is claims against the entity. And 3 is income and expenses, which is changes in those economic resources and claims. And finally, under financial information is that when you are presenting this information, we are going to be presenting it using accrual accounting. Accrual accounting. And accrual accounting states that when you are recording your income, you record it as soon as it is earned, and not when you have received cash. As soon as you have earned it, or as soon as you have done the work, as soon as you have performed your obligation, record income. Don't wait until you receive money. Otherwise, you will not be reporting the economic activity. So accrual accounting, as soon as you have done your work, record income. Whether the person has paid or not, it doesn't matter. So you recognize income when it is earned and not when cash is received. And you recognize expense when it is incurred and not when cash is paid. Okay, just like you renting a building. Your rent is due on the 1st of the month, but you have not paid to the end of the month, right? That does not mean you will not recognize the rent as an expense, even though you have not paid. Economic activity shows that you have started enjoying economic benefit from that house, so you would expense it. So you provide this information using accrual accounting. That's why you see that IFRS is on accrual basis, and that's because that's what the conceptual framework has mentioned. That this is how we present our information using accrual accounting. And that is it around the financial information. Okay, so I'm done with chapter 1. I've explained the objective, I've explained the users and their information need, and I've explained the financial information. So let me be sure that you understand everything I've said. So the first question states that you can unmute yourself and participate now. if you want to. So it says that the conceptual framework makes it clear that financial information should be prepared using A, cash accounting, B, accrual accounting, C, all of the above.
B.
Accrual accounting.
Yes.
Okay, that's correct. 2 states that which of the following is a financial information provided by an entity, according to the conceptual framework? A, statement of financial position. B, statement of profit or loss and other comprehensive income. C, statement of claims against the entity. D, all of the above.
C.
C.
That's correct.
Claim
Yeah,
against the entity.
that's correct. That's correct. It's claims against the entity. That's correct. Yeah. The next question says that which of the following is a user of financial information according to the conceptual framework? A, government, B, lenders, C, employees, D, tax authority.
Lenders.
Lenders. B.
Okay,
Lenders.
okay, good. That means you were following. Okay, so let's mute now. Let's have a brief discussion again, then we'll go back to our quizzing. Okay, I'm sure you're happy that you're getting everything. Don't worry. The next quiz won't be that easy. Okay, so listen up again. Now, let's move to chapter 2 of the conceptual framework. And this talks about the qualitative characteristics of useful financial information. Qualitative characteristics. So what this is saying is that we want to look at the attributes a financial information must have before it can be useful to the users. The attributes it must have. It's just like you having an attribute before you can make somebody your wife, make somebody your girlfriend, something like that. So before a financial information can be useful, these are the characteristics it must have. And that's what we want to look at. There are 2 qualitative characteristics, 2 of them. One is fundamental characteristics, and 2 is enhancing characteristics. 2. The fundamental characteristics, they are the characteristics that makes the information either useful or not useful. That is, if the financial information possesses these characteristics, it becomes useful. If it does not possess it, it's not useful. That's fundamental. Then the enhancing characteristics makes it more useful or less useful. That is it. Okay, so let's go into them. Let's start with the fundamental characteristics. There are 2 fundamental characteristics, and they are relevance and faithful representation. That means that relevance and faithful representation is what makes the financial information useful. If it is not relevant, or if it is not faithfully represented, it is not useful. Don't forget that. We'll soon get to our quizzing. Okay. When we say an information is relevant, you all know what that means. When somebody is relevant to you, it means that that person make a difference in your life. That person, without that person, your existence might be a bit difficult. So when we say that the information must be relevant, so what we are talking about is that it must be capable of making a difference in the decision that is made by user. Don't forget, if you remember chapter 1, the objective of financial reporting is to provide information about a reporting entity to users to enable them make decisions. So what users need information for is to make decisions. So the information that you are providing to them must enable them to do that. So it must make a difference in their decision. And for it to make a difference in their decision, It must have a predictive value. It must also have a confirmatory value. If examiner asks you to explain relevance at corporate reporting level, nobody will ask you to do that anyways. So, but I mean, understanding what we talk about relevance, the key point here is that for you to make a difference in the decision made by a user, it must have predictive value, it must have confirmatory value. When we say predictive value, it simply means that users should be able to use it to make decisions. Sorry, it means that users should be able to use it to make predictions. Predicts. When I say predict, it means that when we look at your revenue this year, you should be able to predict your future revenue. When we look at your asset this year, you should be able to predict, and it must also have confirmatory value, meaning that when that future comes, we should be able to say, okay, I was right, or yeah, no, I was wrong, stuff like that. Confirmatory value. So confirmatory value is there's nothing you can do about that. It's just what happens in the future. Okay, we are in the future. Now, I mean, this confirmatory value is just saying that the company should be a going concern. It must be there in the future. You should not disappear, right? Confirmatory value. They should continue, right? So, but predictive value. I mean, what they can ask in your exam is that how can a financial information have a predictive value? That is what they can ask at your financial reporting class. Sorry, a corporate reporting class. At financial reporting, that's when they'll be asking you explain relevance. Nobody will ask you that at corporate reporting. So you see, there are different ways in which financial information can have predictive value. One of the ways is by providing comparative information, which most financial statements does. So if you are preparing financial information of 2024, you must give us comparative information of 2023. So that if I see that last year you made a revenue of 10 million, and this year you are making a revenue of 7 million, I will know that this one cannot do so well. Last year he made 10, this year is making 7. Maybe next year the guy will be making 5. You see, if you remember, I don't know if most of you should have learned IS 12 deferred tax. Even IS 12 says that before you can recognize the deferred tax assets, the company must have an history of profit making. If the company is not making profit, they say you cannot recognize deferred tax assets, because from where do you want to recover the tax from when you have an history of making? So even IS 12 was predicted on this conceptual framework here. It's trying to be relevant, right? So providing comparative information can help the financial information to have predictive value. Another one is that disclosing one-off items that are material, items that ordinarily don't happen every year. So if they just happen this year, right? It's just like a company that took advantage during that COVID era, and he now took advantage by maybe an hospital that ordinarily just treat people, whatever, or maybe a pharmaceutical company, for example, now. So they were not lucky because of COVID. They were the one that was producing vaccine. Do you know what will happen to their revenue? It will skyrocket, no problem. But they must put it that the reason why we are making so much money is because of COVID. Though. If COVID should go, money again, nobody would take vaccine again. So one-off material items should be disclosed. It can make the information have predictive value. Another one is provide information on discontinued operations. So if you want to discontinue an operation, maybe a component of your company or a branch of your company, you need to present those information separately. IFRS 5 will teach you that, how to do that. Because by the time you present it separately, now people can see that, this company is already divesting. People will start making decisions, right? It's just like GSK, for example, that exited Nigeria last year. People who started shouting, hey, they exit. It's because people don't read. If you have looked at their financial report, it was already there. They have started divesting since 2016. They have been divesting components. They have been reducing as far back as 2019. Their staff base reduced from almost over 400 to 67. The next year, it came to like 15. So ordinarily, people should have known, right? People should have been able to predict that this company is going to shut down. This company don't want to produce. In fact, they have stopped producing since. So when they left and people were surprised, I made a comment around that. Why are you surprised? These guys have left the country. If you just look at their report, it's there. So reports like that, when you provide information around discontinued operation, it's people will be able to predict, right? Also, providing information on non-current asset held for sale. So if you want to sell an asset, or if there's a change in intention around an asset that ordinarily you want to use to generate profits, to generate income, now decide that, oh, I don't need it, you want to sell it. You need to let the user know, because it might be your key asset. So that people can make predictions that, this guy don't want to do this business again. Oh, let's start selling our shares. So all of these and more would help a financial information have predictive value. And that is what we are talking about, right? I've mentioned almost 4 points to you guys. It's in your notes anyways. Or is it? I hope you have noted it down. If you have not, you can always watch this video again to get those points that I've mentioned. Okay. Finally, on relevance is materiality. Materiality is very important in relevance. Materiality can render the financial information irrelevant. Because when we talk about materiality, we are talking about an information that if you omit it, or if you misstate it, it will material. The phone, stop it.
Sorry, I can't hear you.
Anybody? Hello, can you hear me?
Yes, sir.
Can hear you
Yeah,
now,
we
yeah.
can hear you now.
Okay. All right. So sorry. So where did I stop?
Can hear you now.
On
Okay.
materiality.
Oh, okay. Okay. All right.
Materiality.
Okay. 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 So, materiality is extremely important when it comes to relevance, and materiality can render a financial information irrelevant, can render it extremely irrelevant, because when we talk about an item being material, it means that omitting the item or misstating it will influence the decision that is made using that financial information. That is what we mean by materiality. It can influence the decision of the user. So when you omit a material item, that means it's irrelevant. People would not need it. It's irrelevant to the user. So, and that's relevance. For me, for my corporate reporting students here, what I see here that I can ask you is around this predictive value. Nobody will ask you definition, whatever, materiality, and know the relationship between materiality and relevance. Okay, now the next one is faithful representation. Faithful representation. So generally, what this means is that when the information you have presented, you are presenting, must represent, in fact, you must present a representation of the economic activity. Your information must represent your economic activity. That is faithful representation. That's what it really means. But looking at the conceptual framework, the way the conceptual framework defines or talks about this faithful representation, it says that, it first of all says that a financial report represents an economic phenomena in words and number. So it now says that what I've said now, that the information must really represent the relevant phenomena. So it's a bit complex, but what's the direct thing is this. When we talk about a financial report, everything you find there is information around assets, liabilities, income, and expenses. So whatever you are presenting must show or must represent the underlying economic activity. If your economic activity states that your income is 50,000, don't present 100,000. That means you are not faithfully representing it. Just present the right thing to us. I mean, we are trusting you that you do the right thing. That is faithful representation. And I mean, what faithful representation looks at is that the information must be complete. Everything, put it. Don't omit anything. Put everything there. It must be neutral. Don't be biased, right? Don't say because analysts have predicted that you make a profit of 10 million this year or 20 million this year, you're now working towards that. No, you cannot be working towards analysts. You have to work towards improving the efficiency of your operations so that your profitability can even surpass that of the analysts. So don't be biased, right? Focus on your economic activity. And lastly is free from error, right? So what we are saying there is this: whatever figures you're presenting must not contain error, right? And when we are talking about free from error majorly, what we are looking at here is that the description of the phenomena, I mean, the way you have described the economic activity must be free from error. And also the process by which the financial information was produced must be free from error, right? It's just that the description of the economic activity, the process which the information was produced must be free from error. So you see here that free from error does not mean that the figure should be accurate, because figures in the financial report cannot be accurate. It cannot, because financial information majorly are prepared based on estimates and judgments. You will learn that very soon. So free from error here means that the description of the phenomena should be free from error, and the process by which the financial information is produced should be free from error. So we are saying your accounting system, your accounting process should be free from error. You need to set up the right accounting process. Don't go and expense what you should ordinarily should capitalize. I mean, when you're setting up your software, for example, now your chart of account must be properly marked. That is free from error. That's the process of developing that information. And that's what we are talking about here, not the figures. It's not the figures we are talking about here. Free from error. The description of the information or the economic activities, and also the process by which the information was produced should be free from error. Going forward is faithful representation. You will see that majorly is around that the information should be complete, the information should be neutral, the information should be free from error. So complete, I mean, there's no further anything I can tell you about completeness. It's just that produce everything, give us everything about the transaction, tell us everything, don't hide anything. If there was a contract, if anything that has impact in financial reporting that's relevant, how you obtain that contract, if it is a one-off contract, if we are just getting commission, if you tell us all the information we need to know, give us the necessary breakdown. Neutral, don't be biased, right? So the only thing you just need to know around neutrality, which was introduced in 2018 back into the concept, it was removed in 2010. It was reintroduced in 2018, and that is what we call prudence. So neutrality now is now supported by prudence. And most of you have a general knowledge of prudence, right? But specifically, I need you to see prudence as that we do not want you or do not overstate your asset and income, and do not understate your liabilities and expense. That is prudence. Don't overstate your assets and income. Don't overstate it, because those are the items people are always tempted to overstate. They always want to bloat their assets. They always want to bloat their income in most cases, just to look good. And they always want to understate their expense and their liabilities, right? It's arguable from the tax perspective though, but generally, from the investor's perspective, they want to make their reports look good. And especially from the management perspective, whose earnings are usually based on profitability, they always want to bloat these figures to look bigger than normal. Okay, and that's what prudence is talking about. So the conceptual framework defined it as the exercise of caution when making judgments under conditions of uncertainty. Exercise of prudence when making judgments under conditions of uncertainty. That is how it has defined it. And a question has asked, they asked this question, I think 2021, yeah, that for 10 marks, that you should discuss the argument for and against the reintroduction of prudence into the conceptual framework. So those are the kind of questions they ask you. Argument for and against the reintroduction of prudence into the conceptual framework. So if I was in the exam that night, I would have probably gotten the entire mark, because all I would just be playing around is looking at what prudence really is. This one, exercise of caution when making judgment under condition of uncertainty. I mean, it's just too big English for me, right? For you, just see prudence as don't overstate your asset and income. Don't understate your income and expenses. There you can raise why prudence is actually good. and maybe why prudence is not good, right? So again, we are looking at the argument for or the advantages of prudence generally. One of the key advantages to start is to start from number one, which is that it's going to improve the reliability and credibility of the financial reports. That's the first one. And two is that it will ensure that preparers do not mislead the users, and you can trickle down from there actually. And the downside or disadvantages of having this prudence is that, because there are some areas introduced by prudence, like impairment, for example. Now, impairment is saying that yes, there is a portion of your assets that we feel you cannot recover, or there is a portion of your trade receivables that we feel you cannot recover again. So remove it from your trade receivables. And most of these items are determined based on estimates. So that's the false downside of prudence, because it will result in manipulation of financial reports, because users can take advantage of those areas to mislead the users, right? So guys, I would really appreciate if you can make research into this area. Please don't forget. Please don't forget. I need you to look at the advantages and disadvantages of prudence. Make research. It's going to make it stay with you in your. Please do not forget. Okay, that's for neutrality. Is supported by prudence. Now, free from error. I mentioned that free from error does not mean that the figures should be accurate, because I told you it cannot be accurate because we make use of estimates and judgments. And what we call that is measurement uncertainty. Measurement uncertainty. Measurement uncertainty means that the figures in the financial report are not so certain, are not certain. We don't use a point estimate in reporting. They are based on estimates, they are based on judgments, they are based on models. They are not an exact depiction. It is not an exact depiction. So that's what we mean by measurement uncertainty. So usually I would show you areas, because faithful representation, measurement uncertainty can affect it. When the level of measurement uncertainty is too high, meaning that the level of estimate is too high, that means you would take advantage of that estimation. It's either you can help you increase your profit or decrease it, or increase your asset or decrease it, the way depending. So IS1 requires that entities must disclose areas of high level of uncertainty, because the conceptual framework states that faithful representation is affected by level of measurement uncertainty, which means that if the level of estimate you are making or judgment you are making is too high, you have to let the user know, right? I will show you. We'll start presenting that. That's probably one of the first things I'll show you next week before I start IFRS 2. So it's a disclosure part. They will list where measurement uncertainty. One of them is going to be the impairment of financial assets, determination of useful life, determination of fair value. All of these areas, they make use of estimates. They will disclose everything and let us know that the level of uncertainty here is, measurement uncertainty is high, so apply these areas with wisdom. And also, still under faithful representation is substance over form. Substance over form. The full meaning of, or the full word of this substance over form is economic substance over legal form. And this simply means that in reporting, or when you are presenting your financial information, for you to faithfully represent it, what you must represent must be the economic activity, which is what this guy is calling economic substance. That is what you must report, economic substance, over the legal form. You don't present us the legal form. What you should present to us is the economic substance. We are not interested in the legal form. We are mostly interested in the economic substance. But the reality is that in most cases, the legal form and the economic substance are always the same. They are mostly the same. So areas where they are not the same, then you have to present the economic substance, right? An example of those areas is a situation whereby the ownership of an asset is different from the control of an asset. So the guy that owns the assets is a separate person. The guy that is controlling the asset is another person. As far as we are concerned, is the guy that's controlling the asset that we would put in our books and attribute the asset to that person. So if we are preparing the account of whoever is controlling the assets, right, we'll put in his books that, yes, you own these assets, even though he's not the owner, but he controls it. When we say control, it means money is coming to you. You are the one that make decision about the money that is made on these assets. So in that case, there's a conflict between legal and economic substance. We go with the economic substance. It's just like saying that you sold goods to somebody on credit. You sold goods to somebody on credit. So when you sell goods to somebody on credit, see, ordinarily, we just recognize revenue. You recognize revenue. But ideally, substance will say that there is no free credit anywhere. Substance will say there should be an element of interest that you need to also recognize that you are making, because they believe that you'll have factored that interest in your selling price. Now you need to split that revenue into the actual revenue and interest income as economic substance, right? So, and all of those things, right? So the major backbone of economic substance is saying that we must report financial information according to the economic substance and not their legal form, which means we are focused on control. We are focused on the economic activity and not some contracts and not some legal elements or ownership. No, is the underlying economic activity we want to look at. And if you don't follow that, you are not faithfully represented. That's the main thing there. And that's the fundamental characteristics. Then the enhancing characteristics, those ones are quite straightforward. I won't take so much time on that because this one either makes it more useful or less useful. And one of that is comparability, which means that you should be able to compare your financial statements. We should be able to compare it with previous year, and we should be able to compare it with other entities. And the way that can happen is to ensure that the method of accounting you adopted is consistent. That's what consistency means, yes. Your method of accounting, the way you treat items must be consistent. You cannot in one choose cost model to measure your PP. In year two, you are now using evaluation model. That would derail consistency. That would derail comparability. So you must be consistent in treating your items. Secondly is disclosure of accounting policies. For comparability to occur, you must disclose relevant accounting policies, right? And you must not change accounting policy anyhow. Because accounting policy, don't forget, I told you that is how an entity has tailored IFRS to their own situation. It's how they have adopted the IFRS. So you must let us know, because if you don't know, how will you know whether it's cost model you have adopted or evaluation model, or are we going to know the components of your own cost, or how are we going to know whether you have used the fair value, whatever? So disclose accounting policy, it makes comparability possible. Don't forget, comparability, you must be able to compare your financial information of the current year with the previous year. And we must be able to compare your financial information with other entities, of course, that are within the same industry. If they are not within the same industry, it might be a bit difficult to compare because it might not be so favorable if you are doing inter-industry comparison. And of course, they have to be in the same country also, because if you are comparing a company in Nigeria with a company in the US, that's unfair. Cannot do that kind of comparison. So comparability must be reasonable. The second one is verifiability. And when we talk about verifiability, what we are talking about here is that, to put it simply for you, we should be able to recheck or recalculate your figures. Should be able to recheck or recalculate the figures you have in the report, right? Looking at the note I presented to you, it means that independent professionals must be able to reach a consensus about your depiction, right? What I have here is a peak from the conceptual framework. So, but listen to my explanation, right? So what verifiability means that we need to be able to calculate and we check your figures. So if you pick your figure of your figure of PP, for example, now, and it's 10 million, the information you have provided in your financial information should be able to make professionals recheck and recalculate, meaning you must tell us the cost, you must tell us the useful life, you must tell us the depreciation method you have used, you must have explained the process. Remember, free from error. You must have explained the process with which you have prepared the account. So everything is disclosed. So somebody can easily recalculate and get almost the same figure as you. And that is verifiability. Should be able to reach a consensus, right? Not necessarily an exact depiction. Not saying that we must get the same figure. No, but it should be similar. Even if there's difference, it should be immaterial. And next is timeliness, which means that the report must be delivered to the users when it is needed. But we are not saying that you should not be rushing and omit key informations, right? You can make it not useful if you are not careful. So you must strike a balance. Don't joke with the fundamental characteristics. You must ensure every information is there. Remember, faithful representation must be complete. Finish it. But I mean, you have to be efficient in your process and ensure it gets to the user when they need it. If they don't get it when they need it, it's going to be less useful. But if they get it when they need it, it will be more useful. And that's timeliness. And finally is understandability, which majorly says that the report should be simple, concise, and straightforward. That if somebody like me, a financial reporting tutor or a practicing accountant, I pick up a financial report and I don't understand it, there's something wrong with that financial report. A professional should be able to understand the financial report. So understandability here, we're not talking about just anybody, we are talking about professional. That was how I was referring to myself, right? So yeah, what this guy is saying here is that whoever is reading the financial statements, that user must have reasonable business and accounting knowledge. Okay, and that's the people we say should be understandable too. Somebody that has no business knowledge, that has no accounting knowledge, you now want to pick a financial report and understand it. No, now you can't understand it now. If everybody can understand financial report like that, so how are we accountants? How are we supposed to eat? How are we supposed to be eating? So is we professional they are talking about here that it should be understandable to us, right? So people that have reasonable business and accounting knowledge. So that is the qualitative characteristics. It's a lot, but it's quite straightforward. But when ensuring your financial reports meet this, don't forget the benefit of providing the information needs to justify the cost of providing and using the information. Meaning, the benefits must always outweigh the costs. If you are a one-man business with a turnover of like 2 million per annum, nobody is forcing you to do any of this. No one. You're talking because you really don't have to prepare financial report that much. It's just for your own use. So here we're talking about users or reporting entity that has huge user base, that's probably a listed company. So those ones, the benefit of providing that information would override the cost. There are some companies, in fact, all companies that are listed on the market, right? When they release their report like this, it's going to affect their share price. In most cases, their share price either goes up or down. By the time analysts have predicted that this company is going to make $2 billion, they now release reports. They saw that they made $5 billion. Everybody will rush to the share. This one is doing well. It will skyrocket the share price of the company. So those kind of company now, the benefit of providing the information outweighs the cost. Whatever it is they are paying the auditors, they will recover it. Okay. I mean, I hope that was not boring. No problem. If it is, you have no choice. You have to still listen to it because they'll ask it in your exam. Okay, so let's be sure that you understand it. So the first question here, please pay attention. This one is not as easy as the one we are looking at for now. So the first question here states that comparability is identified as an enhancing qualitative characteristics in the IASB's conceptual framework for financial reporting. Which of the following does not improve comparability? A, restating the financial statement of previous years when there has been a change of accounting policy. B, prohibiting changes of accounting policy unless required by an IFRS or to give more relevant and reliable information. C, disclosing discontinued operation in financial statements. D, applying an entity's current accounting policy to transaction which an entity has not engaged in before. So which of the following does not improve comparability? 99% of you might get this wrong. So let's say you can prove me right, you can prove me wrong. Who knows the answer?
D.
That's wrong.
Could it be D?
That's correct. Who was that? What's your name?
A former.
I said D.
Former. Former. Nice one. Nice one. Is D. Applying an entity's current accounting policy to a transaction which an entity has not engaged in before. That will not improve comparability. Please, can you, somebody's speaker is making some disturbing noise. Please mute. Thank you. So that D is the only one that will not, because when you restate financial statements of previous year, when there has been a change of accounting policy, yes, it's good now. When you change accounting policy now, and you need to update previous year's report to that updated accounting policy. It's just to ensure that the 2 years are comparable. Design up, I think you should mute. There's an underlying noise coming from you. So this second one also, prohibiting changes of accounting policies unless required by IFRS. Yes, that will also improve comparability. If people are just changing accounting policy anyhow, it's a problem. We will not be able to compare. We will not be able to do comparison. So this year, the guy uses cost model. Next year, he uses evaluation model. We can't compare. So when they prohibit it, which is what is happening right now, so it improves, it improves. Another one is disclosing the continuing operation. Yes. So it will improve comparability because by the time last year, the company has 4 segments. This year, they have 3 segments. You will know that they are not comparable. So people will not just be judging, they are not doing well. They are not doing well again. But by the time you have disclosed this continuing operation, people will know that, okay, this is the reason why the revenue fell, because they want to close one of their segments, right? So it's D. This is the answers. Ifoma, kudos to you. Fantastic. That's a good one. So let's see. The second one. Faithful representation is a fundamental characteristics of useful information within the IASB's conceptual framework for financial reporting. Faithful representation, yes, we know that. So which of the following accounting treatments correctly applies the principle of faithful representation? A, reporting a transaction based on its legal status rather than its economic substance. B, excluding a subsidiary from consolidation because its activities are not compatible with those of the rest of the group. C, recording the whole of the net proceeds from the issue of loan notes, which is potentially convertible to equity shares as debts. D, allocating part of the sales proceeds of a motor vehicle to interest received, even though it was sold with 0% interest free.
C.
Wrong. Wrong. Which of the following accounting treatment correctly applies the treatment of faithful representation?
It's A.
A.
A. Yes.
Are you sure?
A.
Yeah.
Yes.
A.
So
Yes.
from the way I was spitting and shouting, so you believe that reporting based on legal
Legal status cannot be is probably based on economic substance.
B.
Correct.
It's B. It's A.
so
B.
it's not A, it's
You know, it can
It's
be.
B. B.
B.
It's
So
B.
B. Okay, so let's look at B. Let's look at B. Excluding a subsidiary from consolidation because its activities are not compatible with those of the rest of the group. Okay, Mr. Kazun will teach you this one. So the revised IFRS 10 now prohibits exclusion of a subsidiary from consolidation unless there is Please, can you still hear me? I know you can't
You
see
can
me.
hear me now. You can hear before.
Okay, good. So
Now,
good. So exclusion of a subsidiary now is prohibited. You can't exclude. So it's not, the answer here is not B. Okay? The answer here is not B.
So the
The
answer is
answer is, eh?
the answer is A, sir.
So upon all the noise I've been making, so you think reporting legal status is faithful representation? If I catch
They
you
have
there,
to be economic substance.
what do you say?
It has to be economic substance, not legal.
Exactly. Exactly. So the answer cannot be A. The answer is D. The answer is D.
Allocation part of the sales proceeds of into interest received.
So that was what I gave you this example when I was explaining substance over form, that if you sell goods now on credits, that there is an element of interest there, even though you did not charge the person interest, there's an element of interest there. Because how can you sell good on credit? You will have factored in, you have increased
Yes.
the the selling price. So ordinarily, we would expect that you separate the revenue into the core revenue and interest income, right? And which is what this D is talking about. Allocating part of the sales proceeds of a motor vehicle to interest received, even though it was sold with 0% finance. So this one is just telling you that, yes, they actually sold it on credit and they didn't charge interest. But allocating part of the sales proceeds to interest received is faithful representation. So the thing is that most organizations don't do this. Nobody does this. Everybody just recognize everything as sales proceeds. But you as an accountant must know that there is no free credit anywhere. There should be an element of interest that you must have recognized. Even with IFRS now, when companies give their staff loan and they don't charge interest, you as an accountant, you must identify what is if this staff was going to borrow this money outside, how much interest would this staff will have been charged? That is the interest you should charge and put in P&L. A good auditor should have updated that and recognized the right amount as finance cost. That's faithful representation. And that's substance over form, right? Okay, I hope all my talking would have helped you. Now, the third one. So this states that financial statements represent transactions in words and numbers. Financial statements represent transactions in words and numbers. To be useful, financial information must represent faithfully these transactions in terms of how they are reported. Which of the following accounting treatments would be an example of faithful representation? Right? A, charging the rental payment for an item of plant to the statement of profit or loss, where the rental agreement meets the criteria for a finance lease. Including a convertible loan note in equity on the basis that the holders are likely to choose the equity option on conversion. Derecognizing factored trade receivables sold without recourse. And then treating redeemable preference shares as part of equity in the statement of financial position. Take your time, don't rush. I'm not in a hurry. We want to teach you to pass and pass very well, so nobody is rushing. Take your time and answer this. We'll be closing the class very soon, continue next week, but answer this. Yeah. It seems you have misunderstood my take your time. We are talking. Oh yeah, what's the answer?
I think B.
Okay. Can try again. You can try again. Say no.
I'm leaning towards A. A.
A. A. I think it's
That area, man, is not reliable.
B.
Like, the answer is C.
C.
Did you say C?
C.
Yes, I was
Yeah.
about to say C.
But you didn't say it. So the answer is C, actually. So derecognizing factored trade receivables sold without recourse. Yeah, because when you factor a trade receivable, you can mute now, please. So when you factor a trade receivable, it means that you have transferred the trade receivables to another party. It means that you have told another party to go and pursue and try to collect money from your debtors. That is what we mean by that you have factored it. So ordinarily, when you factor it and is without recourse, it means that even though the guy is unable to collect the money, the guy cannot come and meet you and say, I cannot collect it too. Because when you factor, it means you are selling. So the guy will have, if your trade receivable is like 100 million, the guy will have probably paid you maybe 70 million in advance and say, no worry, me, I'll go and collect the 100 million. So that 30 million will be like his profit. So if the guy now get there and is unable to get the money, it's none of your business because you sold it without the cost. Right. So if you do recognize that kind of trade receivables, yeah, that's faithful representation. But that means that if it is with the cost, meaning the guy can come back and say that I'm not able to collect it, to take back your trade receivables and give back my money. You cannot recognize that kind of trade receivables. You cannot. And this one too, this is not faithful representation. It's a finance lease. So mostly a rental payment will not go to POL because most likely they will have been capitalized, right? Another one is convertible loan. We usually split it between equity, the equity element and the liability element. You cannot just treat everything as equity. You will learn all of this. Then redeemable preference shares too. You cannot treat that as equity. No, redeemable is liability. Redeemable means that we collect our money back. So when you say redeemable preference shares, we have to give them their money back. So we have an obligation to pay cash. That is a liability. So you cannot treat that as equity. So is this one. So why you are getting this question correct wrongly is that you see, you are still new, you don't understand most of these options. Even this one self, I just said the answer. No, none of you have bothered to ask me. Okay, I think I explained this. Okay, I explained this. I think I've explained this too. You need to understand why which of them is not. These are very good questions, right? So when we are done with this quizzing, I think we'll have to stop here for today. We won't be able to finish this 10:20, except we want us to continue, which I won't advise. So number 4 says that which of the following is not a fundamental characteristic identified in the conceptual framework? A, faithful representation, B, relevance, C, materiality, D, reliability.
A.
Samson.
Reliability.
Yes, that's correct. Reliability. That's the answer. Faithful representation is a fundamental characteristic. Relevance is a fundamental characteristic. Materiality is what determines relevance. It's under relevance. So you cannot say it's not, even though there are two fundamental characteristics, but materiality has close relationships with relevance. So the only one that is far from it is reliability. That's correct. Number 5,
Okay.
in accordance with the ISB's conceptual framework for financial reporting, Which qualitative characteristics assumes that users have a reasonable knowledge of business and a willingness to study information with reasonable diligence? A, relevance. B, faithful representation. C, understandability. D, verifiability.
B.
Please, can I take the question again?
Understandability.
Understandable.
I mean, somebody has answered it correctly, so I won't take it again. Understandability. So,
Okay.
which qualitative characteristics assumes that users have a reasonable knowledge of business and remember when I was explaining understandability, I was saying somebody like me should be able to understand it, and that's what that is talking about. Okay, should we stop here or should we continue?
Let us stop here.
Stop. Oh, let's stop.
Yes, so I agree with you. I really would want my class to be ending by 10, but this topic is theoretical, but it's deep. It's very deep. So just be very careful with it. So we have done chapter 1 and chapter 2 today. Do you have the notes, my online students? Do you have this note?
No, sir.
No, sir.
Okay, so please remind me on our group that I should forward this note to you so that you can have it. So next week, hopefully we are going to start from chapter 3, financial statement and the reporting entity. I really thought I was going to finish this today. Chapter 4, still a lot. Chapter 5, chapter 6. It's okay. So I really appreciate you guys for your attention and patience waiting till now. You can see that some have left. No problem. We'll have the recordings. So I appreciate you guys. Thank you very much. And do have a wonderful night. Bye-bye.
One more thing.
Thank you.
Thank you, sir.
Yeah.
Hello, sir.
Yes, yes, I'm with you.
So please, the recordings of this class, the classes we've had, can we get them maybe like few hours or a day after the class so we can go over it? We can go through it over and over again.
No problem. We'll make that happen. We'll make that happen.
Okay, thank you,
Yeah.
sir.
Okay.
Good night, sir.
Thank you.
All right, thank you, sir.
Yeah, bye.
Oh,